Canada's speculative-grade corporate default rate hit roughly 8% by late 2025, more than 3 times the global average of 3 to 4%. On the same trading week, Statistics Canada reported that manufacturing sales rose 3% in March to $73.6 billion, the highest level since January of last year. These two readings belong to the same country, the same quarter, and in normal conditions, they should not coexist. The surface Sorian Prostate was optimistic. Energy prices drove petroleum and coal product sales up 22.7% to $9.4 billion. Motor vehicle production added a 15% gain in the transportation equipment subsector. Strip out petroleum and coal, and the manufacturing base still grew 0.7% in real terms. Not spectacular, but directionally intact. Taken alone, those numbers describe a Canadian economy regaining traction after a difficult first quarter, defined by trade disruption and tariff pressure. The credit market told a different story. Moody's Ratings published a report this week flagging that the share of Canadian speculative-grade issuers carrying low credit ratings, specifically those rated B3 negative or lower, more than doubled over the past year, reaching a 3-year high. Canada's 12-month trailing default rate reached approximately 8% in late 2025, up from around 2.5% in mid-2022. Moody's is forecasting the rate stays between 5 and 7% through this year, with a recession scenario pushing it toward the upper end. That divergence, a manufacturing top line accelerating while corporate credit conditions deteriorate, is the signal that the headline numbers are not measuring the same economy.
The mechanism that connects these two readings runs through private equity. Nearly half of Canada's speculative-grade issuers are now owned by private equity firms, up from almost none in the early 2010s. That ownership structure matters because private equity sponsors, particularly through a prolonged period of low rates and abundant global liquidity, pursued aggressive financial strategies, debt-funded dividends, leveraged restructurings, that left their portfolio companies carrying elevated debt loads relative to earnings. Those companies are now meeting elevated rates and trade-related cost pressure with balance sheets that were engineered for a lower-rate world. Manufacturing sales growth, by contrast, is concentrated in energy and autos, sectors that are largely publicly traded or crown-backed, not private equity-held. Petroleum and coal product sales of $9.4 billion reflect commodity prices, not debt service capacity. The factory floor is humming because global energy demand and post-tariff auto production timing created a favorable window. The credit distress is accumulating beneath that window, in a segment of the corporate sector that does not appear in manufacturing output tables. This is the condition where the divergence can persist without resolving. If energy prices remain elevated and auto production stays intact, the headline manufacturing number will continue to look healthy while the speculative-grade default rate grinds through Moody's forecast range of 5 to 7%. The manufacturing data and the credit data are measuring two separate populations of Canadian companies, but one of those populations, the leveraged private equity-held segment, is also a significant employer and a meaningful share of overall private investment. A default wave does not stay contained to bond markets.
The unresolved question from the credit layer is whether that default wave can remain isolated from the broader economy long enough for the macro backdrop to ease. Moody's itself introduces one potential relief valve. It expects Canadian public pension funds to recalibrate away from high-risk private equity ownership, tightening underwriting standards and shifting toward downside protection. If that reallocation accelerates, the flow of capital into heavily levered structures slows, and the pipeline of future distress narrows, but that is a structural shift measured in years, not quarters. The nearer-term variable is the Bank of Canada's rate path. Canada's junk bond stress report explicitly cites elevated interest rates as a compounding factor. If the Bank of Canada moves toward cuts through the second half of 2026, debt service coverage improves for the most distressed issuers, and Moody's downside scenario, the recession push toward 8%, becomes less likely. The historical parallel is instructive. In the 2015 to 2016 commodity downturn, Canada's speculative-grade default rate rose sharply before a combination of rate stabilization and oil price recovery allowed it to compress. The current episode shares the commodity price dependence and the rate sensitivity, but the private equity ownership concentration is a new variable that did not exist at the same scale in 2015. On the manufacturing side, the verification benchmark is the next Statistics Canada release. If the energy price tailwind that drove the 22.7% petroleum and coal surge reverses, and global oil prices have been under pressure from Iran-related supply uncertainty, the manufacturing headline flips from a signal of resilience to evidence of a one-sector story. Bank of America, BAC, and the broader financial sector are also watching Canadian credit conditions closely, given cross-border exposure. The lean from the evidence currently is that the divergence versus the summer. Manufacturing holds on energy support, while credit stress stays elevated, but that lean collapses the moment energy prices fall far enough to strip the headline and expose the underlying credit deterioration. The question the market has not yet answered is whether those two moves arrive in the same quarter. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.